The headlines tell us that AI advancements, China's economic stimulus, and policy shifts like Xi Jinping's private enterprise symposium are fueling Alibaba's stock surge. But is this really a sustainable growth story? Or are investors getting caught up in short-term hype? 1. Alibaba's AI strategy, a competitive edge or catch-up game? Let's start with AI. Alibaba has partnered with DeepSeek AI and continues developing its own Qwen AI models. On paper, this sounds promising. But let's break it down. First, DeepSeek's success doesn't automatically mean success for Alibaba. While Alibaba provides cloud services for DeepSeek, the AI firm could easily become a competitor, undermining Alibaba's pricing power. Second, claims that Alibaba's Qwen AI models outperform GPT-4 and Meta's Llama 3.1 remain unverified. AI leadership isn't just about benchmarks, it's about real-world adoption and monetization. And finally, Alibaba Cloud's AI-driven growth has been underwhelming. With just 7% year-over-year growth in Q3 2024, it significantly lags behind Microsoft Azure's 33% and AWS's 19%. If Alibaba's AI truly had game-changing potential, wouldn't we see stronger cloud revenue growth? Bottom line, AI is boosting sentiment, but there's little evidence that it's translating into strong financial gains. 2. China's economic stimulus a real fix, or just a temporary boost? Now, let's talk about China's economy. Many see recent stimulus measures, like interest rate cuts and fiscal support, as a major tailwind for Alibaba. But here's the reality: consumer spending, the backbone of Alibaba's e-commerce business, remains fragile. Youth unemployment is high, real estate troubles persist, and discretionary spending is weak. Alibaba's 57% stock surge over the last 6 months isn't unique. Tencent, Meituan, and other Chinese tech stocks have also rallied. This suggests that Alibaba's rise is driven by macroeconomic optimism, not company-specific performance. Simply put, economic stimulus might provide short-term momentum, but it doesn't fix Alibaba's deeper structural issues in e-commerce, logistics, or cloud computing. 3. Geopolitical risks, the Trump tariff factor. Another overlooked risk: geopolitics. Donald Trump's new tariffs on Chinese goods could disrupt Alibaba's international e-commerce operations, like AliExpress and Lazada, which grew 32% year-over-year in Q2 2024. Beyond tariffs, global firms may distance themselves from Alibaba due to US-China tensions, impacting partnerships and cloud adoption. And then there's AI chip access. Stricter US export controls on NVIDIA's advanced chips could severely limit Alibaba's AI and cloud growth, forcing reliance on less advanced hardware. Investors should ask themselves, is Alibaba prepared for these risks? Right now, the market seems to be underestimating them. 4. Xi's private enterprise symposium, a real shift, or just symbolic? Now, what about Xi Jinping's private enterprise symposium on February 17th? Investors hope this signals a more business-friendly environment for Chinese tech. But let's be skeptical. China has a history of pro-business promises without real follow-through. Jack Ma's return may be symbolic, but it doesn't mean the regulatory risks are gone. The government stance can change quickly, meaning Alibaba's long-term regulatory risks remain. While the symposium might provide a short-term boost, we shouldn't assume it marks a major policy shift. 5. Alibaba's future, high risk, high reward. AI growth is uncertain, Alibaba faces fierce competition, and lacks a clear monetization strategy. China's economic stimulus is not a permanent fix, consumer confidence remains weak. Geopolitical risks, including tariffs and AI chip restrictions, are largely underestimated. Xi's symposium may boost sentiment, but it doesn't guarantee lasting regulatory relief. Final verdict: caution over euphoria. Yes, Alibaba has potential, but right now, the risks are competitive pressures, regulatory uncertainty, and geopolitical headwinds are too significant to ignore.